Okay, so we're Aroway Energy. I got to admit, this is my first visit to the PDAC. I know this isn't really a PDAC event, but I didn't really know what that stood for, PDAC, until about a couple minutes ago when a girl who works for me explained what it was. So I'm quite happy to be here. I think the big theme that you're going to hear, probably if you visit most of the companies, I think most of it's mining companies, is how everybody is undervalued and, oh, we're getting beat up by the market. And, you know, the oil and gas companies are quite similar. I just like to refer to it as that we are underpriced as opposed to undervalued. We're just not getting the love. So our basic shares outstanding, we have 61 million shares, 61.8 million shares. That consists of 3 financings that we've done. We did 2 financings, kind of back-to-back in 2010. All the major funds in Canada took part in those, and then we didn't do a financing for 2 years. We operated on our cash flow. And we actually just completed a financing in December 2012, led by Secutor. It was a brokered deal we did in December. We raised $4 million to mostly a flow-through to drill a bunch of exploration wells that we have in our capital budget. I'm a big believer that you don't drill exploration wells on debt, just because of the risk involved, and you can bear your company pretty quickly. We have a market capitalization of 33%. Founders and insiders own 22% of the company, so we participate in every financing going forward. Our current production is a little over 1,000 barrels a day. When I first got into the business, the big goal for all companies was once you get to 1,000 barrels a day, the market loves you. You're golden. You're self-sustaining. You're bringing in millions of dollars. You know, you bring in over. We're almost going to be cash flowing next month $1 million a month. And we announced our number, and lo and behold, our stock fell 23%. So I don't know what's happening out there. But anyway, we're 90% oil. There's maybe a handful of TSX venture-listed companies that have over 1,000 barrels a day, and 90% oil. So we're very oil-focused. We have total proven probable reserves of $12.4 million, and land base 110 sections in our core area, and a couple of new core areas there. We are starting to build new positions. So our corporate strategy, we want to continue to develop low-risk, long-life, conventional production. So this is, I like to call it old-school oil and gas. They were drilling wells, vertical wells like this in the 50s and 60s. You know, this year we just got a guy running the company who was born in the 70s doing the same thing. So it's simple, old school, high internal rate of returns. We're really trying to maximize the internal rate of returns because that's where we're getting our cash. The conventional wells, we find they last longer as far as they recycle our cash quicker, and they have longer reserve lives than a lot of the non-conventional type horizontal wells with all the multi-stage fracs. Those are really expensive wells to drill. They cost, you know, they cost a lot of money, $2 to $3 million. And sure, the production comes on really quick out the beginning, but probably lasts at that high rate of production for a couple of months, and then you have a pretty steep decline curve. So we like to target reliable 8 to 15-year life oil reserves through our joint venture partner and through strategic acquisitions. We apply production methods, primarily water management. Water's always been a word nobody likes to say in the oil and gas industry, because you know, once water comes in, then your reservoir is starting to get corrupted or whatnot, and so we're always trying to manage our water. We're not afraid of the water, so we're always applying proper water management to make sure we can extend the life of our production. We like to implement a cost management initiative, so to increase our net backs. And what I mean by that is, for instance, we just did a recent acquisition in Saskatchewan, and in order to increase our net back, what we've started to do is rail our oil. So a lot of companies now are, in fact, I read an article in the National Post yesterday that CN is actually doubling the capacity that they're going to be railing oil down south because it's in such demand now. And for us to rail our production, we're no longer having to pay the pipeline fees, pay the fees to dilute the oil to get it to proper spec. There's all kinds of fees and tariffs that are involved in that. And so we're actually eliminating that by railing our oil and actually adding $6 to $9 to our netback. So we're really conscious of the fact on how to increase our netbacks and bring more cash to the company. And we're also looking to exploit the current, kind of buyer's market. We look at it. There's a lot of oil companies out there, or oil and gas, mostly gas-weighted, that have a lot of really good assets, but they're in distress. They have too much debt, or they can't afford to drill their properties, and so there's a big buying opportunity for companies like ourselves who have lots of cash on the balance sheet. We've got good cash flow, and a pretty good stock price which we can use for currency. So there's a lot of good opportunities out there which we're looking to exploit going forward. This is our core area, the Worsley area. This is the Peace River Arch area of Alberta, and if you see the little red square there, back in July 2010, that's what we started the company with. It was a simple 4-section farm-in with a private company. Today we stand with over 110 sections. So all the green squares, that's all our land now in the Peace River Arch. So we've just grown from that 4 sections to over 70,000 acres in that area. And the key here that I want to stress upon is that our joint venture partner owns and controls the infrastructure. So by the infrastructure, the gas plant, the oil battery, and pretty much all the pipeline, all the red pipeline that runs east-west on the map. Owning the infrastructure is, I can't stress enough, and I mean, if you don't own your infrastructure, sometimes you can't get your oil or your gas to production, get it to market it, and I've seen many companies fail because they just can't. They can drill a great well, but if you can't get it to market, you're not making any money. So that's one of the big strengths that I see in our big core area play here, is that our joint venture partner owns the infrastructure. The type of wells that we're drilling up here are our riskier type Leduc wells. So these wells, if you look at, just to give you a flavor of what kind of wells we can drill in this area, and we have drilled in the past. This graph on the bottom here is a well that we drilled in 2011. That well did over 900 barrels a day, and we were 50% of that, so 450 barrels a day to us net for well over a year, and stayed at that level. So just to monetize that, we've produced to date over 260,000 barrels of oil from this one well, which translates into about $23.5 million of gross revenue we've pulled out of this well alone. And that's on a gross basis, so about 11.7 net to us. So these are the type of wells that we're drilling up here. They're really big wells. They're all not like this, but these are the type of wells you can drill up here and that we are looking for. So lots of upside, that's for sure. This is our Saskatchewan acquisition that we did. This is where we're actually shipping the oil via rail. We purchased this in November of last year, November 2011. At the time, the kind of going market rate for purchase of heavy oil assets was about $40,000 a flowing barrel. We managed to get this at a little over $10,000 a flowing barrel. And that's, again, a reflection of how the market is. There's some distressed companies out there. They can't, for whatever reason, keep their operations going. And with this asset alone, we expect to drill a couple of infill wells, upgrade the facilities a bit. Right now it's producing approximately 300 barrels a day, and we'll probably get that to over 600 barrels a day by just doing a bit of work on it. So there's lots of assets out there like this. It takes a lot of work to find them, but they are out there, and this is one of our strategies. Another area that's a big core area for us going forward is the Kirkpatrick Lake area. This is an acquisition we did, again, in September of 2012. We've drilled a couple of wells here. Again, if it's got nice light oil. We've been getting good rates of return on it. All of our assets have high internal rates of return. So that's a big thing. I think we're doing between 200 or 300 and 500 is our average internal rate of return on most of our properties. Majors are a fraction of that. So it's a lot of these properties are very rewarding with high netbacks to the company. This is a slide of our company growth. If you look up in the top left, that's our production growth per million shares. So when we started the company in 2010, we exited at 100 BOE a day. 2011, we were at 669 BOE a day, and then again, 2012, we exited at over 1,000 barrels a day. So this is a really good chart because it shows, kind of the measure of drilling success and the not taking into commodity prices and all that kind of stuff. And it really shows, that we're really doing well in what is a depletable asset. Every time you drill a well and bring it on production, it begins depleting immediately. So when we exit, 2011 at 669 BOE a day, to go up to that 1,000 barrels a day, we're actually having to add probably another, 600 or 700 barrels a day just because it's depleting. So, we've done a pretty good job at increasing our production growth, and we expect to continue to remain on this pace of production growth into 2013 and beyond. So I guess just to wrap up with our competitive advantages, we are an oil-weighted company, which we're focused on oil. Gas right now is depressed, so we're very lucky in that. Like I said, there's not a lot of juniors out there with over 1,000 barrels a day of oil production. We have above industry internal rates of return. Like I said, we're at between 300% and 500%, where the majors are at between 20% and 25%. So we're actually making a lot of cash. We have a pretty good sustainable business model in our conventional drilling. We're guaranteed access to the infrastructure in our main core area in the Peace River Arch. Again, I can't stress how important that is. Lots of cash flow. Judy Ann, in my director of communications, always says to me, she says, cash is king, but cash flow is King Kong. So management and insider ownership aligns, and we have a strong ability to raise funds. So that is Aroway Energy, and if you have any questions, just come over and see us, and thanks a lot.